Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I'm your host, Christopher A. Panayiotou, Certified Financial Planning Professional, the Cap and Capitalize. And on today's episode, I'm going to get into a unique situation on how to capitalize your finances during a layoff or career change. But as always, before we get into it, the free advice for the week. For every dollar you have coming in, not from your salary or business, but from your investments, all things being equal, you don't need as much saved up for emergencies. And I just wanted to throw that out there because I have a lot of people that ask, how much do I need for an emergency fund, which is very valuable. You need about 3 to 6 months of emergency fund money, which we're actually going to talk about in today's episode. But as your portfolio starts to pay you more and more and more, by definition, you won't need to save up as much. So what happens with an emergency fund is over time, you get to that 3 to 6 months, you build up a portfolio, and as your portfolio, let's say, pays you $1,000, $2,000, $3,000 a month, let's say that you need $4,000, $5,000, $6,000 a month to spend. Well, then by definition, your emergency fund grows, and then you actually don't need as much because your portfolio can basically pay for your life. And then what happens is it starts to grow again, and as your worth starts to really skyrocket, and we're talking skyrocket, that's when you start to have an institutional mentality with money where you go, okay, out of my net worth, maybe I want to have 5 or 10% of my portfolio in cash at all times. So I know that was a little elongated for the free advice, but I just had to throw that out there because a lot of you have been asking me, how much do I need for an emergency fund? And it will ebb and flow and evolve over time. So that does it for today's free, very elongated advice for today's episode. And now let's get into the belly of the beast. So talking about layoffs or career changes, a layoff or career transition, it can feel disruptive because it is, but financially, it can also become a strategic opportunity to reset, optimize taxes, and reposition your wealth. Many high net worth individuals actually make some of their smartest financial moves during low income years. If you need to repeat that, rewind it and listen to it again. So for today's episode, I wanted to throw out my structured approach to capitalizing your finances during a layoff or career change. So first and foremost, you're going to want to stabilize your cash flow. So before making strategic moves, you want to ensure your liquidity. And there are a couple key priorities I want to throw out. And this is in no particular order. You're going to want to build or preserve 6 to 12 months of living expenses. Now, is this extreme? Yes. But if you are going to pivot, you're much rather going to be, you'd much rather be safe than sorry. You're also going to reduce or pause non-essential spending. And you know exactly what that means. You're also going to review your fixed obligations that you can't get around: mortgage or rent, insurance, subscriptions, debt payments. So from a strategic move standpoint, if your cash flow is tight, you're also going to want to temporarily pause your retirement contributions instead of liquidating investments. And in the short run, is that the best option? Probably not. But long term, if you play your cards right and bet on yourself, it is going to pay off massively. Now, the second thing I want you to think of is turning a low income year into a tax opportunity. A layoff often means your tax bracket temporarily drops. That creates very powerful planning opportunities. And there's a couple things that you can think of. You could think of a Roth conversion strategy. So you convert some of your pre-tax retirement assets into tax-free assets in a lower bracket. So here's an example. Let's say you convert $50,000 to $150,000 from your traditional IRA or 401k into Roth money. Reason why you would do that is because in this unique year, you're in a lower tax bracket. Therefore, you can get away with something I call bracket bunching, where if you're normally in the 22% bracket, but suddenly you're going to drop to the 10 to 12% bracket, that gives you a window between the 12 and 22% bracket that you could convert that difference from traditional IRA or 401k into Roth, and you're still within that low tax bracket. It's extremely powerful. So by paying the taxes in a lower bracket, your future growth becomes that much more tax-free. And this applies to your traditional IRAs, your old 401ks, some cases current 401ks or 403bs or 457s if you work for a government entity. You got to just check with your company to make sure that you can do conversions during that year with your current employer. This also works for SEP IRAs or simple IRAs. What I just went over is one of the most powerful wealth building moves during career transitions. Another thing you can think about is realizing capital gains strategically. So if your income is low enough, you could take long-term capital gains for investments that have been held for longer than a year. Your gains, your tax bracket could drop to zero. So to give you an idea of what that looks like in 2026, if you are married, filed jointly, assuming you are married and you filed jointly, if your capital gain is from zero up to $94,000, if I remember correctly, your capital gain tax rate is 0%. And then from 94 to like 583, it's 15%. Above that, it's 20. So the reason why I bring that up, you could sell appreciated stock and pay zero tax. I'll actually give you a quick story. I have a new client. Obviously, I'm not going to say what his or her name is, but she had or he had a situation where this person decided to quit the job, and the year before, this person got a bunch of stock options, and this person is choosing not to work for the next couple of months. So I looked at it and said, whoa, your tax bracket is going to be basically nothing. And because of the stock options and concentrated stock that this person had in the business that she or he worked at a couple years prior, in normal circumstances, if you wanted to get the gain out and realize the tax consequence, that person would have been in really the 23, 24% tax bracket plus 7%. Because Washington State has a capital gain tax over $250,000. But because of this very unique situation, I got this person's tax bracket from the, for all practical purposes, 32% bracket down to 14.6 blended tax rate. That is almost 20% of a return on investment in taxes this person won't have to pay. So very valuable and very, very real. Another thing you want to look at is harvesting tax losses. So if the market or investments within your portfolio in your non-retirement account have dropped, you could sell your losing investments, capture the loss, and then offset other capital gains that you have, whether it's gains from selling a stock or just qualified dividends. And there's a bunch of benefits. You offset the capital gain. You can deduct up to $3,000 in losses against ordinary income. And then you can carry any losses that you didn't use. You could carry those forward indefinitely. And that is tax loss harvesting 101. Another thing you can think about is optimizing your retirement account. So if you leave a job, you often have 4 options with your company retirement plan. You can leave it with your old employer. You can roll it to a new employer. to your new employer's retirement plan, assuming they have it. You can roll it to an individual retirement account, or you can convert it to a Roth IRA. Most advisors would recommend rolling that 401k to an IRA. And why would they do that? Well, you have more investment options, lower fees, and it's an easier Roth conversion strategy. I would say the most optimal, if you have a company retirement plan, is to, assuming the fees are lower, roll it to that new plan. One, it's just easier because you have one less account to worry about. And then two, the fees are going to be lower in a company retirement plan versus an individual retirement plan. And if that company, your new company, has the ability to convert from 401k to Roth 401k, you're going to want to do that there as opposed to doing it with a Roth IRA conversion. Another thing you're going to look at, this is the fifth strategy, use health insurance strategically. So healthcare planning becomes massively important, and there are a couple options. You could go on COBRA, which is keeping your previous employer's plan. You could go out to the Affordable Care Act marketplace, although that could be going away in the not so distant future. Or you could just latch on to your spouse's coverage, or if you have a domestic partnership and your partner has the ability within their company benefits to bring you on, you could do that as well. So low income years could produce some pretty large Affordable Care Act subsidies, but again, emphasis on could. In the example, if you're a family or part of a family and earning 60 to 90 grand, you could actually qualify for significant premium reductions. Another strategy to think of is rebalancing your portfolio in years in which you're laid off or you're thinking of the career move. And career transitions, they're good moments to review risk. And there's a couple questions I want you to ask yourself. Is my allocation aligned with my goals? Do I hold too much employer stock? Think about the example I mentioned earlier, which is a real life example. Should I diversify concentrated portfolios, which normally ties into, do I hold too much employer stock? And I hate these blanket statements in blanket strategies, but there are some typical diversified structures that I see out there that could be appropriate. Again, this is not investment advice, just for my compliance people that get really paranoid about me saying things that I shouldn't. A typical diversified structure I see is a combination of U.S. equities, so U.S. stocks or index funds or mutual funds, international equities, bonds, alternative investments. You could also throw some CDs or money markets. I talk about this in my first book in detail, Capitalize Your Finances. So if you haven't read the book yet, head on over to capitalizepodcast.com, go under products, go under books, and snag Capitalize Your Finances, the first book of my series today. Now, we're going to take a quick commercial break. I really want you to absorb everything I went through because there is a lot, but don't go anywhere because when we come back, we are going to consider strategic debt moves that you can make during a layoff and or career change. So don't go anywhere. Stick around.
Are you ready to transform the way you approach sales? This episode is sponsored by the second book in the Capitalize series, Capitalize Your Sales, the all-in-one sales framework that saves you from ever struggling again and teaches you how to sell with sincerity, which dives deep into the art and science of driving sustainable growth. Packed with strategies that go beyond surface-level techniques, this book will help you understand what it takes to truly connect with clients, build long-term relationships, and close deals. Whether you're looking to fine-tune your sales craft or break through to the next level, Capitalize Your Sales offers a roadmap to success designed for today's fast-paced business world. Head on over to your favorite bookstore, order today, and start capitalizing your sales immediately. And now, back to the episode.
Welcome back from the commercial break. Hopefully you absorbed everything that came out of my mouth before the commercial break because it's only going to compound in terms of knowledge, complexity, and options that you have if you're trying to capitalize your finances during a layoff or career change. So as promised before the commercial break, we are going to get into some strategic debt moves that you can make during this time. if interest rates fall or your income drops, there are some possible moves for you to think of. You could think about a mortgage refinance. You could think about a student loan income-based repayment. You could think about refinancing, frankly, any debt that you have, or you could consolidate some high interest debt into, say, a 0% APR debt payment for 12 months, something along those lines. The point that I'm making is by avoiding the liquidating of your long-term investments to pay off your low-term debt, your low rate debt, in the long run, you're going to make way more money on the spread by doing that. And you're not paying taxes, even though you will be in a lower tax bracket during this year. Now, this one's a little unique in terms of a recommendation. Invest in career capital. So sometimes the highest return on investment during a career transition is yourself. There's some examples. Maybe you take the time to invest in a professional certification. Maybe you go back and get your MBA or your executive education. You could invest in skills training, industry networking. These moves can dramatically increase future income potential. Now, we're talking about all of this upside, but you can't forget to protect your downside. During transitions, you're going to want to review your insurance, disability insurance, life insurance, health insurance, and health coverage. Many people lose coverage when leaving an employer. And so for you, if you are going to do that and it's going to be an extended period of time until you get another job, you may not need disability insurance because you're unemployed anyway. So why pay for something you don't need? Life insurance, very, very valuable, especially if you have a family. If you go through that extended period and you don't find a job and you die, you're going to want to make sure that your family's taken care of. And if you get really, really sick, you want to make sure your health coverage is dialed. And if you are curious about who to go to for health insurance questions, if you go to my business's website, capitalizeyourfinances.com, and you scroll under professional partners, there are a bunch of health insurance experts versus brokerage or individual health insurance experts. Just give them a call. Just let them know that I sent you. Now, another thing I want you to think of, create a career transition budget. This is kind of a unique one. So I want you to divide your expenses into essential expenses that you just can't get around: housing, food, insurance, transportation, and then flexible expenses: travel, dining, subscription, shopping, just to name a few. And by doing that, this is going to give you control over the runway while searching for the right opportunity. Another thing you need to think of is maintaining your investment discipline. The biggest mistakes I see people take during layoffs or career transitions: panic selling investments. History shows that markets recover. Am I guaranteeing that? No. Past performance doesn't guarantee future returns, yada, yada. I get it. But there are examples. We've recovered since 2008's financial crisis. We recovered during the COVID-19 market crash, which lasted a whopping 4 months. Investors who stay invested typically recover faster than those who exited the markets. Another thing you need to look into is use this time to truly long-term plan and revisit it. Career transitions create space, and you can reassess a number of things: your retirement goals, your business opportunities, your side income streams, your lifestyle priorities. Many successful entrepreneurs actually started companies during their layoffs. Who knows? That could be you. So the strategic summary that you need to think of during a career transition or during a layoff, I want you to focus on 5 financial levers. The first one, cash flow stability. The second is tax optimization, so Roth conversions, capital gains. The third is investment discipline. Fourth is healthcare planning. And the fifth is career reinvestment. If you handle these well, a low income year can become a major wealth building opportunity, and it could be the best wealth building opportunity of your life. So that does it for today's episode on capitalizing your finances during a layoff and or a career transition. As always, I'm your host, Chris Paniotu, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing. Take care. As always, thank you for joining me today. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris at capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Chris Paniotu, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth ERA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution (RM&D) in the year you convert, you must do so before converting to a Roth IRA. A Roth IRA offers tax deferral on any earnings in the account. Qualified withdrawals of earnings from the account are tax-free. Withdrawals of earnings prior to age 59.5 or prior to the account being open for 5 years, whichever is later, may result in a 10% IRS penalty tax. Limitations and restrictions may apply. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. No stock investment strategy or risk management technique can guarantee return or eliminate risk in all market environments. Stock investing includes risks including fluctuating prices and loss of principal. Rebalancing a portfolio may cause investors to incur tax liabilities and slash or transaction costs and does not assure a profit or protect against a loss. Asset allocation does not ensure a profit or protect against a loss. There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Before investing, carefully consider money market funds, mutual funds, or index funds risks, investment objectives, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. Bonds are subject to market and interest rate risk if sold prior to maturity. Bond values will decline as interest rates rise. Bonds are subject to availability, change in price, call features, and credit risk. Alternative investments may not be suitable for all investors and should be considered as an investment for the risk capital portion of the investor's portfolio. The strategies employed in the management of alternative investments may accelerate the velocity of potential losses. Christopher Paniotu is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Capitalize Your Finances LLC is a separate entity from LPL Financial. Capitalize Your Finances is not registered as a broker-dealer or investment advisor. CRPS conferred by College for Financial Planning. LPL Financial Insurance License Number 0518721. LPLIA Insurance License Number OB91442.